As of March 19th, 2026, Freddie Mac's average 30-year fixed mortgage rate was 6.22%. The Federal Reserve had just held the federal funds target range at 3.5% to 3.75%. February CPI was running at 2.4% year over year, and the latest existing home sales snapshot showed a 4.09 million annual pace, a $398,000 median price, and just 3.8 months of inventory. That is not a cheap money housing market, and it is not a crash market either. It is a selective market. And that is exactly why high mortgage rates are reshaping the middle class. They are changing who can buy, who can move, who can stay liquid, and who gets trapped by a payment that looked manageable only in a good month. So stop looking at mortgage rates as a headline and start treating them as a structural force. A higher mortgage rate does not just make a home more expensive, it changes your monthly payment, your required income, your savings rate, your emergency fund strength, your career flexibility, and the amount of risk your household can absorb. The middle class feels this first because it lives in the zone where housing is not a luxury purchase and not a cash purchase. It is a leveraged cash flow decision. When the cost of leverage stays high, the entire shape of middle-class life changes. You need to understand the operating mechanism. Housing is priced twice. First by the sticker price of the home, then by the financing cost attached to that price. In a low-rate cycle, buyers can tolerate higher prices because monthly payments stay somewhat contained. In a high-rate cycle, that same price becomes a different experience entirely because the financing layer absorbs more of the household budget. Then the market adds another level. Sellers hold out, buyers hesitate, builders offer incentives selectively, and mobility slows because owners with old, low-rate mortgages are reluctant to trade them for new, high-rate loans. That is how rates reshape behavior before they reshape headlines. The biological equivalent is stress response. A healthy system adapts under pressure. A weak system breaks under pressure. Your household finances work the same way. If your income is strong, your fixed costs are controlled, your liquidity is real, and your debt is manageable, higher mortgage rates become a constraint you can evaluate. If your savings are thin and your budget is already full, the same rate environment turns ordinary decisions into dangerous ones. The middle class is being reshaped, not because everyone is suddenly poor, but because high financing costs reduce the margin for error. When the margin gets small, the definition of affordable changes. That is the point most people miss. They think mortgage rates matter only if they are actively shopping for a home. Wrong. Mortgage rates affect renters through tighter supply, affect owners through mobility lock-in, affect families through school district decisions, affect workers through relocation choices, and affect small investors through the return threshold needed to justify property risk. Even people who are not buying today are living in a world shaped by the cost of housing finance. That is why this topic is not really about mortgages. It is about middle-class optionality. And the backdrop matters. Household debt reached $18.8 trillion in the fourth quarter of 2025, with mortgage balances at $13.17 trillion. While the personal saving rate in January 2026 was 4.5%. That is not a picture of broad household collapse, but it is also not a picture of massive financial slack. It means many households are still operating with limited cushion at the same moment housing finance remains expensive. In that environment, a mortgage is not just a wealth-building tool. It can also become a cash flow stress multiplier if you size it badly. So here is the first rule. Do not buy a house based on the maximum payment a lender will approve. Buy based on the payment your life can survive. That sounds basic, but this is where middle-class households quietly damage themselves. If the mortgage, taxes, insurance, maintenance, and ordinary upkeep leave you with weak reserves and no real savings margin, then the house is not stabilizing your life. It is consuming your flexibility. You should be able to make the payment in a normal month, a mediocre month, and a bad month without immediately depending on perfect future income growth to save the decision. That means you do not react to a high-rate environment with denial. You react with structure. If rates are high and the payment is too large, you do not stretch just because the property looks right. You lower the purchase price, raise the down payment, choose a different market, delay the purchase, or improve your cash position first. You do not solve an affordability problem with optimism. You solve it with math. If the market moves against you after closing and your budget was already tight, you do not have an asset problem first. You have a liquidity problem. The second rule is that you must separate the home decision into at least 3 time frames. The first is purchase stability. Can you survive the first 12 to 24 months without expecting a refinance rescue? The second is medium-term flexibility. If your income changes, family needs change, or the local market softens, can you still function without panic? The third is long-term ownership value. Does this property still make sense over 5 to 10 years once taxes, insurance, maintenance, and financing costs are all included? Most middle-class buyers fail because they compress all 3 into one emotional yes. They like the house, assume the future will cooperate, and call that planning. This is why the phrase, "you can always refinance later," is one of the most dangerous middle-class scripts in a high-rate era. Maybe you can refinance later. Maybe you cannot. The rate path may not help you soon enough. Your credit profile may change. Your income may weaken. Your home value may not rise the way you expected. Or the savings from a refinance may be too small to repair an originally bad purchase. If rates stay high, you need the deal to work now. If rates fall later, that is upside. It cannot be the foundation of the decision. Here is how you handle the market tactically. If mortgage rates fall modestly, but home prices and competition jump immediately, you do not chase as if lower rates automatically improved affordability. You recalculate the full payment and compare it to your reserve target and savings rate. If mortgage rates rise or stay firm while inventory inches up, you do not automatically panic. You negotiate harder, demand concessions, and let patience work for you. If rates stay around current levels and the payment still crushes your budget, you rent strategically and strengthen your balance sheet instead of forcing a purchase to satisfy a social milestone. The correct move is not buy or wait. The correct move is protect structure. Existing homeowners face a different version of the same issue. A household sitting on a mortgage originated in the 3% range is living with a hidden asset, cheap financing. That means moving is no longer just a lifestyle choice. It is often a financing trade. If you sell a home with a low embedded mortgage rate and replace it with a home financed near current levels, the payment jump can be severe, even if the house itself is not dramatically more expensive. That lock-in effect slows mobility, changes career flexibility, delays upsizing and downsizing, and creates a kind of quiet middle-class gridlock. The housing market then feels slower, not because people are indecisive, but because the financing penalty for moving is real. This is where most people stop, but this is the advanced level. Once you understand payment shock and mobility lock-in, you need to see the second-order effects. A 6% to 7% mortgage environment does not just reduce affordability. It changes labor mobility because workers are less willing to move. It changes family formation because housing upgrades become harder to justify. It changes small business creation because more household cash flow is tied up in shelter costs. It changes portfolio construction because households must hold more liquidity if housing now consumes a larger share of income. And it changes class identity itself because the middle class increasingly divides into people who locked in cheap housing costs earlier and people who must build a life under a much more expensive financing regime. You can see that strain in the market data. Existing home sales are still running below older normal levels, even with some recent improvement. And January new home sales fell to a 587,000 annual rate. That does not mean demand vanished. It means affordability and financing terms are still shaping how much demand can actually transact. High mortgage rates are not just suppressing activity, they are filtering it. Buyers with stronger balance sheets, higher incomes, more family support, or more flexible location choices can still move. Buyers without those advantages face a much harsher equation. You also need to understand correlation breakdown and liquidity traps inside housing. In easy years, people assume the house, the job, the stock portfolio, and the local economy will all cooperate. In stressful years, they can all weaken together. A job loss can coincide with a weak resale market. Insurance and property taxes can rise while wage growth slows. A household may own a valuable property on paper, but still be cash flow fragile because the asset is illiquid and the carrying cost is fixed. That is the housing version of a liquidity trap. The value can exist, but it cannot save you quickly enough. Then there is bankruptcy math, and you do not need literal bankruptcy to feel it. If housing consumes too much of your monthly budget, every other financial goal gets crowded out. Your emergency reserve builds more slowly. Retirement contributions become inconsistent. Childcare, education, transportation, and health costs become more stressful. One large repair or one income interruption can erase months of progress. The arithmetic is unforgiving. The tighter the monthly payment, the less room you have to recover from error. That is how high mortgage rates reshape the middle class. They turn housing from a wealth platform into a risk amplifier for anyone who buys too close to the edge. Behavior makes this worse. Overconfidence tells people they can handle it because their careers will improve. Anchoring makes them compare today's purchase to a 2021 mortgage fantasy instead of today's actual budget. Chasing trends makes them rush into neighborhoods or home types that already moved beyond their safe range. Poor risk control makes them ignore total monthly cost and focus only on principal and interest. And ignoring time frame makes them buy a house as if every phase of life will cooperate with a 30-year obligation. These are not small errors. In a high-rate environment, they are class-shaping errors. So make the decision the way an allocator would. First, define your maximum all-in housing cost before shopping. Second, require a real post-close liquidity buffer. Third, stress test the payment against income interruption, insurance increases, maintenance surprises, and slower wage growth. Fourth, separate the emotional desire to own from the financial question of whether this specific purchase improves your long-term position. Fifth, compare the house not only to rent, but to what the payment does to your saving rate, investing capacity, and career flexibility. That is the middle class playbook now. The home has to fit the system, not just the dream. If the market moves in your favor, react with discipline. If rates decline meaningfully and you can refinance into a clearly better payment without extending bad behavior, do it. If inventory improves and sellers become negotiable, use that leverage instead of acting like every listing deserves urgency. If the economy weakens and your industry becomes less stable, delay the purchase even if rates look slightly better. A fragile income plus a big fixed housing cost is not a strategy. It is a vulnerability. If you already own and are thinking about moving, calculate the financing trade honestly before you call the move an upgrade. To practice this skill, write the decision down before you make it. Journal the intended purchase price, the all-in monthly cost, the reserve target after closing, the expected holding period, the downside scenario, and the condition that would make you walk away. Then reverse test it. Ask what would make this purchase look reckless in 12 months. Ask what happens if rates stay high, if your income stalls, if repairs arrive early, or if the local market softens. That process strips away the illusion that a mortgage is just a homeownership decision. It shows you that it is also a risk management decision. To maintain good judgment, review your household structure the way an investor reviews a portfolio. Measure housing cost as a percentage of take-home pay. Measure months of liquidity after all fixed obligations. Measure the gap between total monthly cost and stable income, not just current income. Measure how much a move would reduce or increase your ability to save and invest. Review this quarterly, especially if you are planning a purchase or contemplating a move. The middle class gets reshaped slowly through fixed costs that become normal. You counter that by making the structure visible. You should also combine housing decisions with other tools. Use valuation to judge whether the property itself is attractively priced relative to local reality. Use macroeconomics to understand the rate regime, labor market risk, and inflation backdrop acting on your budget. Use technical housing signals like inventory, days on market, concessions, and transaction volume to judge whether the local market is firm or softening. Use risk management to cap what one housing decision can do to the rest of your financial life. Valuation without macro can make you buy too early. Macro without local market awareness can make you wait forever. Housing data without risk management can make you confident in the wrong price range. Then test your thinking under pressure. Run a personal stress test where your household income drops by 20% for 6 months. Run another where the home needs a major repair in the first year. Run another where the refinance you expected never arrives. If the purchase still works, that is strength. If it only works in the best case version of your life, then the rate is not really the problem. The fragility is. So here is the clean conclusion. High mortgage rates are reshaping the middle class by changing affordability, freezing mobility, widening the gap between owners with cheap old financing and buyers facing expensive new financing, and forcing housing to compete more directly with savings, investing, and everyday resilience. The people who handle this environment best will not be the ones who sound the most confident. They will be the ones who keep liquidity, size housing sanely, respect time horizons, and refuse to let one real estate decision dictate the rest of their financial life. And here is the detail worth replaying, because the whole script quietly depends on it. The true cost of a house is not the payment you can make in a normal month. It is the payment you can still carry when the world becomes less forgiving.